this signal to give you actionable advice so you can make informed decisions. Joining me this week is Chris, as always, and we apologize beforehand. This call is going to be technical, and we're going to get into the yield curve, and I know that can be technical. It is an important signal and something that we want to get into because we will be making decisions on that. So if you gloss over and you don't like the technical things, please subscribe and hit that like button before you leave. We really appreciate you tuning in, but we'll try to make it simple and easy to follow as best we can.
Now that we already lost 75% of our viewers, let's get going.
All right. Well, what about price points? The market, we had bad news last night with Netflix. I expected to see some market pull back off of that, but the futures have recovered this morning. Netflix is not. It's down more than it was and aftermarket. So it's good to see the market recover after such bad news. Yesterday we have support around 43.91 on the S&P 500. We have resistance at about 46.31. Just call it 4,400 and 4,600 if you're looking at these components for the S&P on their price points. And then we're going to get into the yield curve. Tell us a little bit about
the recent story is still the bloodbath in bonds continuing.
Right.
So looking at this chart, this is week over week. We saw a parallel shift up in the yield curve along the 2-year, so the mid up to the long end. So that's that red line last week, and the blue line is yesterday. We've seen an increase in yields up about 20 basis points. We can also compare back to that yellow line a month ago where we had that real flat yield curve. So the good news is there's some steepening of the yield curve. But as yields move up, prices are coming down. I don't know if you've had a chance to look at the indices lately. Do you know how much bonds are down on the year?
I know it's rough. I know that. You got equity-like losses in your bonds.
Over 9% losses on the Barclays Ag, which is what most people follow as their index, and the Muni index is down about 8% as well. And it gets even worse. So a lot of people will just buy corporate bond indices. It's worked well for years. So you get investment-grade corporates, and they buy the market of corporate bonds, which tends to be even higher duration. And then you have the credit risk as well. Some of those are down 10 to 13%.
Right. So we've been warning for quite some time that bonds were not going to be a place to hide going forward, that you're going to have equity-like risk, so you might as well have equity investments so that you get equity-like positive return potential, because there just really wasn't much left that could be had in those bonds. And if you really needed to remove that volatility, you needed to be in cash or cash equivalents, which is one of the things that we've been focusing on our fixed income strategy. It's a strategy that's done well.
We continue to like where we are, right? We're only down about 4.5% in qualified accounts and 6.5% in non-qualified, so beating the indices, but still down.
The main thing that we have to worry about there is just inflation, which we continue to struggle with. Well, we talked about the yield curve, and I think the financial media is really laying it on pretty thick on trying to say, don't pay attention to this. This is not the indicator that you should pay attention to. I would say it has 100% accuracy so far. Now, 2020, a lot of people will say that's just luck. The yield curve inverted, and then we had a recession, but the recession was due to the lockdowns from COVID, not the inverted yield curve. Well, it didn't play out, so we didn't actually see what would have happened if there weren't any lockdowns. I know we were in agreement that that probably wouldn't maintain its 100% accuracy at that time, so I guess you can call us in the luck camp, but I don't think that means you should ignore the yield curve. I think the yield curve is important. It's not the only story, and if you're looking at this slide, you can see time frame. It takes some time for the yield curve before you have a recession, and oftentimes the yield curve is no longer negative whenever that recession comes up.
And we did bounce off the inversion, right? It was only inverted for a short period of time. Are you expecting that to come back?
I at least expect it to stay flat for some time. I think a lot of this is the market's pricing in Fed movement and Fed interest rate hikes. Now the Fed is still sitting on that short end, so we're not seeing that. I don't think they're going to be able to raise the rates like they did in 2005. We'll get there. I don't think the economy can muster that, or I think it doesn't have a lot of momentum, which we'll also talk about.
So what you're saying is the 3-month yield, which we've referenced in the past calls, is still low, and it's going to be tracking with the Fed fund rate as they start raising rates. So once they start raising that, we're going to see a much flatter yield curve, and that's when inversion may come back.
May come back, but the fact that it was inverted is already telling you, the market's already predicting a recession now. They're going into the longer dated bonds to try to offset that. But here is just looking at the interest rate hikes over time. Obviously, there's this trend that we're seeing that we're going to talk about later, where it's like you never get to the point that you were before. And if we zoom in to 2008 recession, we could see that the Fed at that red line was at 1%, and they hiked all the way up to 5.25%. And then they began to actually decrease over time. That yield curve didn't invert immediately. It took quite a few rate hikes before the yield curve finally inverted. And I think that's signaling that they were actually raising rates too much, too fast for the economy to actually deal with, to the point that before the recession happens, they're actually lowering their interest rate, and the yield curve is no longer inverted. But there's a long time that yield curve is flat to negative. Drilling it a little bit further, I think there's, so if the yield curve is important as a signal, rates are important to understand. I think the better signal, or the more timely signal, the one you can act off of, is going to be the credit spreads, meaning high yield credit spreads, so the riskier bonds, and when that's that green line here. So we can see at the time the Fed is lowering interest rates prior to 2008, that green line begins to move up. So does the blue line. That's because that long end of the curve is starting to move up as credit is getting priced into the long end. Sorry to be technical, but the big signal here is all of a sudden it's becoming risky to loan money out to the economy. It's harder and more difficult to get financing for debt that you already have and that you're servicing, and get new debt. And the banks don't want to loan it because the risk of default is there, and they're not getting compensated much to loan because the spread is low. And I think that's the thing that we want to pay attention to. Here's a slide for you.
Yeah, so the index you referenced on the high yield, that green line, now we're looking at actually a breakdown of what bonds are underneath the hood there. So high yield junk bonds are usually defined as BB rated and below. So you can have BB, single B, and triple C on this chart. Really one of the early warning signals is, well, how are those triple Cs being priced? And those spreads are moving up a little bit higher than the rest of it. So we are seeing initial warning signs. That spreads up about 125 basis points on the year. Something to be looking at.
Right, and then looking here, just rehashing that, we see the credit spreads begin to rise. Yield curve is steepening. Fed is actually decreasing interest rates, and then we get the recession. That green line is a much better indicator than just the yield curve. That yield curve is just warning you to start paying attention to what's happening for a recession. Now, let's look at now, because that's what we're dealing with. So if we look at where the credit spreads are and the yield curve, et cetera, we can see we did go negative on the far right side of that with the blue line just dipping. It's starting to go up, but so are credit spreads. So back to that 2008 example, this is not unusual. I don't think we have the momentum in the economy to trug along for a couple of years like we did in 2008. It was a very hot economy. It took a very long time, and the Fed had to get to 5.25%. To start getting that to really slow down, and they raised rates too high from that vantage point. So I don't think we're going to get anywhere close to 5.25. If we did, we're going to have a significant recession. The economy just is not set up for it, and our debt service load is much higher this time. So if 2008 was, everyone seems to agree that it was because of over leverage, how are we doing on leverage right now? So not that great. So this is looking at that red line is the national debt, and its index is on the left-hand axis. So it's moving up 8 trillion-ish in 2008, all the way up to well over.
Slope is increasing on that line.
The slope is increasing also, but you can service more debt if your economy is stronger. So we gotta make sure that we adjust for that. So that dotted line is showing the percentage of debt held as GDP. So prior to 2008, can we go back to this? 60% of the GDP was held as debt. We could have paid it off in a single year if we could have put all that money towards debt. Certainly not the case now. We jump all, and we hit 100% in 2014. 2020 comes back up. We jump over to 130%. We're back down to about 120, 122% of GDP. So from that standpoint, we are far more leveraged, more than double what we were in 2008. Now, the national debt is not the only story. A lot of corporate and personal debt was essentially shifted to the government's balance sheet. But we still see higher debt loads for corporations. That's that blue line. Certainly not grown at the rate that the federal government has. And then also, if we're looking at personal balance sheets, we can see that we're on a nominal basis higher than we were in 2008. If you adjust that for GDP, I'm sure it's not nearly as levered. There is some relief. So I don't think the leverage story is as drastic and as bad as 2008, unless we're talking about the government. But they have the Fed, so
Yeah.
they can always continue to pay us. Then
When-
we got inflation.
When I look at these slides of the consumer, it really comes back to everything we're talking about. If the consumer can get access to credit, they spend.
Right.
And that's what we see. So as long as they have access to credit throughout here, they're going to keep spending, and it's good for the economy short term. It's really the credit conditions get worse, you're going to see pullbacks.
Right, and that's why we're looking at that the credit spreads, because that would indicate that banks are less likely to loan. Now credit will be more difficult to get. We'll see that yield curve, especially on the short end, really move up, possibly invert. So that's why we want to pay attention to this. And all this talk, the Fed hasn't been really doing much other than jawboning. And I think they're going to raise rates, but the market's been predicting it. Banks are actually slowing down their loans. The Fed has not been pulling they're not letting their balance sheet roll off. So there really isn't that much of a contraction, but we're seeing a sharp decline in the slowdown in money supply growth that is not seasonal. Typically around the 30 to 35 week mark, there's a trend change and we start to see a lull in money supply growth. This is way early on a seasonal basis.
And that's that green line
That's
you're
the
talking
green
about
line, yes,
pulling
thank
back,
you.
and likely going to continue to pull back. We're going to see in 2 weeks we'll have more updates on what the Fed's going to be doing at their May meeting. Futures are pricing in almost the certainty of 50 basis points at this time, and we'll get more clarity on the balance sheet runoff. But they're planning to run off, at least now, about $95 billion a month.
Yeah.
Going to tighten conditions.
It's going to. I don't think they're going to really get to that far into it, because I think the recession will be there, and I think they actually see that as a way to wring out the inflation within the market, and then they will quickly probably become more accommodative, and we'll see the market move again. So you don't want to be trying to time this and be all out, because I think inflation on the other side is going to come back. We may get a reprieve through a recession, but if they use monetary policy the way that they have been using monetary policy, I think we're going to see inflation come right back into the thing. So it's a very difficult situation to manage through. We definitely have reduced a lot of the cyclical exposure that we have in the portfolios to a little bit more defensive, trying to offset this. Haven't really raised cash to become defensive. May consider that if all of a sudden we see that CCC paper really beginning to pop up. Know that we're watching it every day.
Yeah, and we can move to earnings. I think you already covered that slide earlier. Really, the big update in earnings that you referenced is Netflix. Stock was down over 40% at one point. They lost 200,000 subscribers on the quarter. 700,000 subscribers were lost from cutting off operations from Russia.
Sure.
So that's to be expected. But where they picked up subscribers was the Asia Pacific. That's a low revenue subscription, and they did lose 640,000 subscribers in Canada and U.S.
Right.
That's the market you don't want to be losing subscribers in.
And you may say, well, if you add back Russia, we go from 200,000 negative to 500 positive. One, that's revenue that is gone, so it doesn't help the stock any. But the expectation was 2.6, or was it 2.4 million?
2.4.
2.4 million. So they were short 2.6 million on what was expected on subscribers.
So yeah, it was a bad quarter. But what's also hitting the stock as well is they guided down for a loss of another 2 million in Q2.
Right.
So that's a significant loss. So they're clearly seeing something that
Right.
consumers are pulling back.
And if this was Disney Plus, I think I would chalk it up to there's this whole cultural war thing going on, and they've recently had a scandal that shows up. Maybe people are unplugging in retaliation from that. Netflix, it's a couple of years since their last snafu. So this seems to be more likely people looking in their wallet because it's starting to get pinched because of high energy, high food prices, and finding places that they can cut. And I think that it's not proof of a recession, but I think it's a confirmation. If they blew it out and they had 3.5 million subscribers and all the data was saying people are continuing to spend, then that would be evidence that the recession thesis is not correct. We're seeing confirmation that it may be that there's some merit to that.
Yeah, so to close out earnings on this chart, what we showed is there's really only been 34 companies closing out last week. So not enough sample to really say definitively what's going on, but at least so far, we've seen the overall surprise at the bottom there, the S&P 500 surprise factor, 9.5% above expectations. We said last week the long run it's about 4 to 5%. We really want to see that 5% beat. So far we're seeing that, but again it's a small sample size,
Right,
so
and
it's something we'll keep looking at.
It's very sector specific, so it's not like
Right.
it's 34 randomly across the 500 that they're surveying. Well,
And some of the financials, that number being higher than it was, they really had lowered their expectations heading into it. So probably not a true full story of what's going on there.
A short hurdle to cross, right? Well, we really appreciate you tuning in. If you have any questions, please go to our website. You can schedule a time with one of our lead advisors, service advisors. If you have any questions, feel free to also give us a call. We're happy to help. If you haven't hit that like button so far, go ahead and hit that like button. And go ahead and share this video by hitting that arrow button and sending it over to anyone you think that would find this valuable. We appreciate you tuning in. We'll see you next week.